In a world increasingly driven by digital assets and cutting-edge artificial intelligence, is Riot Platforms truly building the infrastructure powerhouse of tomorrow?
Or is it maybe a high-stakes gamble on two of the most volatile industries on the planet?
That's the big question. We're about to take a deep dive into every facet of this fascinating company to find out. All right, let's unpack this. Today, we're diving deep into Riot Platforms, Inc., ticker symbol RIOT on the NASDAQ.
Yep, and our analysis, it's built on a comprehensive report from the stockanalytics.ai expert team. The date is locked as of July 15th, 2025.
Right, and our mission here is pretty clear. We want to dissect their business fundamentals, take a look at the management, assess the financial health, and explore their intrinsic value.
Basically trying to give you, our listener, a complete, unbiased picture, all through the lens of a long-term investor.
Okay, let's kick things off with Chapter 1, Business Analysis. So, what exactly is Riot Platforms? You might think, oh, just another Bitcoin miner, but our sources show they're, well, quite a bit more complex than that.
Yeah, what's really fascinating here is that Riot operates as a vertically integrated Bitcoin infrastructure platform.
Infrastructure platform. Okay, so what does that mean in practice?
It means they're not just, buying machines and plugging them in. They're actually building, owning, and operating their entire large-scale infrastructure. Think engineering, construction, all the way through to daily operations.
So end-to-end control.
Exactly. And this deep integration, it's a really smart strategic move. It kind of acts as a hedge against supply chain disruptions, and it helps them aim to be one of the lowest cost producers out there.
Interesting. And it's not just about the mining itself, is it? The report mentions distinct revenue streams.
That's right. Two primary ones. Bitcoin mining is obviously the dominant engine. In FY 2024, that brought in about $321 million.
Wow, that's a big chunk, like 85% of total revenue.
Yeah, around 85.2%. That comes from deploying those specialized ASIC miners to validate transactions and earn Bitcoin rewards.
Okay, and the second segment?
That's engineering. Through their subsidiary, ESS Metron, they design and produce custom electrical equipment. That was about $38.5 million in FY 2024, so roughly 10%.
And that equipment, is it just for external sales, or?
Well, they do sell externally, but what's particularly clever is how crucial it is for their own internal build-outs. It gives them direct control over costs and timelines for their massive projects.
Makes sense. Anything else revenue-wise?
There's a smaller other stream. This includes some data center hosting and something quite notable, earning millions in power credits.
Power credits, how does that work?
Basically, by selling contracted electricity back to the grid during peak demand times in Texas, it's a brilliant move that significantly lowers their net energy cost.
Very smart. And just to be crystal clear for everyone listening, Riot Platforms, the miner.
Absolutely no connection to Riot Games, the video game people. Zero affiliation. Just a coincidence in the name.
Got it. So the main product Riot generates is Bitcoin itself. But their strategy with it is different, right?
Yes. Unlike many competitors who sell mined Bitcoin pretty quickly to cover costs, Riot uses a hodl strategy. They hold on to it. As of Q1 2025, they'd built up a really impressive treasury, over 19,200 BTC.
Wow. And the secondary product is that specialized power equipment from ESS Metron.
Exactly.
Okay, the report paints Riot as a real giant in this space. Can you maybe put their scale into perspective, like hash rate? Physical footprint.
Absolutely. Scale is key here. As of June 2025, their deployed hash rate was 35.5 exahash per second EHs. That's a measure of their raw mining power.
And that puts them
firmly among the top 5 global Bitcoin miners, easily. And their Bitcoin treasury, those 19,225 BTC, that ranks them 4th among public companies holding Bitcoin.
And the physical side. The facilities.
Equally massive.
Yeah.
They own North America's largest Bitcoin mining facility. That's the 700-megawatt campus in Rockdale, Texas.
It's 100 megawatts. It's enormous.
It is, and they're currently building out an even bigger one. A staggering 1 gigawatt that's 1,000 megawatts in Corsicana, Texas. It's truly industrial scale.
So wrapping up this section, for you, the listener, what's the core value proposition here?
Well, for an investor, Riot offers leveraged exposure to Bitcoin's price, but within a familiar equity framework, a stock you can buy. But their stated vision is actually broader. They want to be the world's leading Bitcoin-driven infrastructure platform.
Infrastructure platform again. That signals ambition beyond just mining coins.
Precisely. It hints at leveraging those massive assets in other ways.
Which brings us to industry trends. This space changes so fast. The Bitcoin halving in April 2024 really shook things up, didn't it?
Oh, massively. It cut the mining rewards in half overnight. So efficiency and, crucially, cheap energy became absolutely paramount. Survival is now all about having the lowest possible production cost.
But there's another big shift happening, this pivot towards AI.
Yes, this is maybe the most interesting development. Miners like Riot are realizing their huge power capacity and data center infrastructure are exactly what the incredibly power-hungry AI industry needs.
So Riot's marketing that new Corsicana site for AI.
Actively. That 1 gigawatt site is being pitched for high-performance computing, HPC, which basically means AI workloads. This could create a much more stable, potentially very lucrative revenue stream separate from Bitcoin's volatility.
And the industry itself is maturing.
Definitely. It's now dominated by large, publicly traded corporations. And things like the spot Bitcoin ETFs have added another layer of legitimization.
Makes sense. But competition must be intense.
Fierce. It's dominated by other big U.S. players, Marathon Digital, CleanSpark, Core Scientific, and the game has changed. It's not just about deploying the most hash rate anymore.
It's about cost.
Exactly. Lowest cost to production wins, and power cost is the critical variable. Now, this pivot to AI, it introduces a whole new battleground for attracting stable, long-term contracts. Riot's power assets could be a major edge there.
What about the regulatory side? Sounds like a maze.
It absolutely is. You've got federal agencies, SEC, CFTC, IRS, FinCEN, all trying to figure out their jurisdiction. There are some legislative efforts like the Genius Act, aiming for clarity, which is generally seen as positive.
But it varies state by state, too.
Hugely. You have New York putting moratoriums on certain types of mining, while Texas has rolled out the red carpet, creating a really favorable environment. It's a complex patchwork to navigate.
Given all the cost, the complexity, the regulation, how hard is it for someone new to break into this at Riot scale?
Incredibly difficult. It creates a pretty wide moat for the established players.
Why so hard?
3 main reasons. First, extreme capital intensity. You need hundreds of millions just for the miners and the infrastructure build-out. Second, energy procurement. Securing large-scale, low-cost power is incredibly challenging. The best deals are often locked up.
And the third?
Technical and operational expertise. Running these massive data centers 24/7, optimizing everything, it requires highly specialized skills. It's not a weekend project.
Okay, so significant barriers to entry. What makes Riot stand out then? What are their key competitive advantages?
Well, first, they have strong brand recognition. They're one of the oldest names, often in the financial news. Second, economies of scale give them cost advantages, like better pricing on ASICs.
But you mentioned power strategy earlier.
That's arguably their biggest edge, especially in Texas. They secure these massive, long-term, low-cost power contracts. And then they participate in those demand response programs, selling power back to the grid.
Earning those power credits.
Exactly. It effectively lowers their net energy costs, sometimes significantly. That's huge in a game one on low costs.
Any other unique assets?
Yes. That vertical integration through ESS Metron gives them control over building their own stuff. Their massive power infrastructure, especially the planned 1 GW, potentially aimed at AI HPC, is a rare asset. And finally, their balance sheet.
The Fortress balance sheet.
Yep. Lots of cash and, crucially, unencumbered Bitcoin they own outright, not pledged as collateral. This gives them a war chest for growth and helps them survive crypto winters.
Okay, that's a solid overview of the business. Let's shift gears now into Chapter 2, Management Evaluation. Who's leading this complex operation?
The key figures are CEO Jason Les, Chairman Benjamin Yi, and CFO Colin Yu. And Jason Les' background is pretty unique.
Hi, sir.
He's a former professional poker player, specialized in heads-up, no-limit hold'em.
Poker. How does it translate?
Well, think about it. That game requires deep understanding of game theory, rigorous risk management, psychology, skills that are arguably pretty well suited for navigating the volatile crypto mining industry.
Interesting angle. And what about their track record? Their strategic decisions seem quite bold.
They haven't been shy. The pivot to vertical integration, acquiring Windstone and ESS Metron, the aggressive expansion with the 1GW Corsicana site, proactive capital raising during bull market.
I've been active in M&A recently too, right?
Very active. Bought Rhodium assets, acquired E4A Solutions, took a big stake over 10% in competitor Bitfarms, even tried to launch a takeover bid. It definitely shows they want to be a consolidator in this space.
How are they on transparency and, ethics?
Generally pretty strong on transparency. They provide detailed monthly production updates, good investor relations materials. But This leads to a really significant point: executive compensation.
Ah, yes. What's the story there?
Well, for fiscal year 2024, CEO Jason Less received a total compensation package valued at an astounding $83.53 million.
$83 million. That seems high.
It's more than 10 times the average for CEOs at similar-sized U.S. companies. Now, to be fair, about 98% of that was in stock and options tied to performance.
So for a company that's often unprofitable and burns cash.
Exactly. From a value investing standpoint, that magnitude is really difficult to justify. It raises legitimate corporate governance concerns about potential excessive value extraction by management. It's a red flag for sure.
Okay. And their capital allocation strategy, where does the money go?
It's crystal clear. Reinvest heavily in growth. They're pouring capital into building Corsicana, buying the latest miners. No share buybacks, no dividends since 2017. Pretty much every dollar goes back into expansion.
Which leads to the crucial question. Is all that reinvestment actually generating value? What about return on invested capital?
Yeah, this is where the strategy gets questioned. Riot's ROIC has been consistently negative. We're talking negative 8% to negative 11% on a trailing 12-month basis recently.
Negative ROIC means?
It means they're essentially destroying value on the capital they're deploying, at least based on current earnings.
Right.
However, you have to see it through management's lens.
Which is?
It's a massive, long-term, high-risk bet. They're betting that Bitcoin's future price will soar so high that it retroactively justifies all these huge investments being made today when profitability is weak or negative.
So investing in Riot is basically underwriting that bet.
Precisely. You're backing management's high-stakes wager on Bitcoin's future.
Okay, let's dive into the numbers themselves. Chapter 3, Financial Analysis. What are the key metrics we should focus on?
All right, market cap is around $4.4 billion, so solid mid-cap territory. Revenue growth, as we touched on, has been explosive.
Right, from $12 million in 2020 to almost $380 million in 2024.
Yep, a 5-year compound annual growth rate around 123%. But, and it's a huge but, this growth is incredibly tied to Bitcoin's volatile price swings.
Got it. What about profit margins? This sounds like where things get tricky.
Very tricky. Profitability is extremely volatile and, frankly, often deeply negative. Gross margin is around 32% TTM, which isn't terrible.
But operating and net margins?
That's where it falls apart on a GAAP basis. Operating margin TTM is negative 77.3%. Net profit margin TTM is negative 86.9%.
Wow, huge losses. Why such big swings?
High fixed operational costs are part of it, but also significant non-cash charges. Like in Q1 2025 alone, they reported a $208 million unrealized loss on their Bitcoin holdings because the price dropped during that quarter.
Ah, so the accounting rules force them to mark their Bitcoin holdings to market each quarter.
Exactly, which creates massive paper gains or losses that don't reflect the underlying cash flow reality. You really need to look past the headline GAAP numbers here.
Okay, what about free cash flow then? The actual cash generated after operations and reinvestment?
Consistently and deeply negative. In Q1 2025, it was over minus $181 million. Their aggressive growth strategy just requires massive capital expenditures, far exceeding cash from operations.
Which means they have to keep raising money.
Yes, perpetual reliance on external financing, issuing stock, or taking on debt to fund growth and operations.
So earnings consistency is non-existent.
Pretty much the definition of inconsistent. Wild swings. Like a $109 million net income in FY 2024, then boom, a $296 million net loss just in the first quarter of 2025. Forecasting is almost impossible.
Yet, despite all that red ink and cash burn, you mentioned their balance sheet has strength.
It does, surprisingly. Their debt-to-equity ratio is very healthy, only 0.21. That shows they've mostly funded growth by issuing shares, not loading up on debt.
And liquidity.
Excellent current ratio of 3.23. Means they have over 3 times the liquid assets needed to cover their short-term liabilities. So financially stable in the short term, despite the cash burn, and as we said, no dividends expected.
Valuation time. Traditional PE is clearly useless here. What else can we look at?
Right, PE is meaningless. Price to sales, PS, is around 8.0 to 8.3. That reflects the market's high expectations for future growth.
Anything else?
Price to book, PB, is more reasonable, around 1.5. That suggests the market values the company at about a 50% premium to its accounting book value. Not crazy high for a tech-focused growth company with significant tangible and digital assets.
Okay. Now, intrinsic valuation using a discounted cash flow model, the DCF.
Yeah.
We often use this, but you flagged it as tricky for Riot.
Extremely tricky. Applying a standard DCF here is fraught with peril. Why? Because future cash flows depend almost entirely on Bitcoin's price, which is anyone's guess.
Yeah.
And they're currently burning cash, not generating it.
So the inputs are highly speculative.
Hugely speculative. And the risk profile demands a very, very high discount rate. So any DCF we run is purely for educational purposes to show how sensitive the valuation is. It's not a reliable price target.
What are the key sensitivities?
Overwhelmingly sensitive to two things: the assumed long-term Bitcoin price and the discount rate, or WACC. And get this, Riot's one-year beta, measuring its volatility relative to the market, it's exceptionally high at 4.542.
Whoa, 4.5. So for every 1% the market moves, Riot historically moved over 4.5%.
Exactly. That extreme volatility translates into a very high cost of equity and thus a high WACC in the DCF model, which significantly pushes down the calculated intrinsic value.
So what kind of range does this educational DCF spit out?
It results in a massively wide implied share price range. For example, a bear case may be assuming Bitcoin settles long-term at 75K, and using an 18% WACC due to risk might give you $7 to $10 a share.
Okay, and a bull case.
A bull case, say Bitcoin hits $200 long-term, maybe a slightly lower 14% WACC if they de-risk via AI, could imply $22 to $30 a share. The real takeaway isn't the numbers themselves, it's the extreme sensitivity to those Bitcoin price and discount rate assumptions.
Understood. Okay, that covers the core fundamentals. Let's move into part 2, starting with Chapter 4, Market Sentiment. What does Wall Street think?
Analysts covering the stock are overwhelmingly bullish. You've got a consensus buy or strong buy from something like 94% of them.
And their price targets?
The average 12-month target range is about $15 to $19.01, with some analysts going as high as $23.10. So they generally see significant upside from the current price around $12.51.
How does the general media tone reflect this? Or does it follow Bitcoin more?
It's definitely a direct reflection of market volatility, especially Bitcoin's price. Positive news flow tends to follow rising Bitcoin prices, or when Riot announces positive strategic steps like upsizing a credit line or reporting progress on the Corsicana AI build-out.
And negative news.
Driven by Bitcoin pullbacks, naturally. Also, concerns sometimes pop up about things like insider selling, even if for taxes, or if a rare bearish analyst note comes out.
So analysts are bullish, but what about other market players? Is everyone on board?
No. This is where it gets really interesting. While analysts are bullish, Riot has an exceptionally high short interest. Over 25% of its public float is sold short.
25%? That's huge. What does that mean?
It means a significant number of institutional investors and hedge funds are actively betting against the stock. They think the price is going down.
So a real disagreement in the market.
Exactly. It creates a classic battleground stock dynamic. This makes it ripe for high volatility. And it also creates the potential for a short squeeze.
Explain a short squeeze quickly.
If some positive news hits and the stock starts rising rapidly, those short sellers might be forced to buy back shares to cover their positions and limit losses. This buying pressure can itself drive the price even higher, faster. The data suggests it would take shorts about 1.83 days to cover all their positions, which is relatively quick.
Interesting dynamic. Any technical signals?
From a technical perspective, at the time of the report, the stock was trading above both its 50-day and 200-day simple moving averages. Generally, technicians view that as a bullish signal for both short-term and long-term momentum.
Okay, let's look inside the company. Chapter 5. Ownership structure. Who actually owns Riot?
Institutional ownership is quite high, around 56.5%. It's dominated by the usual large passive index funds. Vanguard is the biggest holder with over 36 million shares. BlackRock is second with 27 million.
Standard stuff for a public company. Anything unusual?
Yes. The third largest institutional holder is Starboard Value LP. They hold about 12.7 million shares.
Starboard Value. They're an activist fund, right?
Exactly. A well-known, highly respected activist investor. Their significant stake is a powerful signal. It suggests that a sophisticated, value-oriented firm sees a compelling opportunity here.
What might they be pushing for?
Could be anything improved capital allocation, maybe urging management to address that CEO compensation issue, strategic changes. Their presence alone could be a future catalyst for change or value unlocking.
Very interesting. What about insiders? How much skin in the game do they have?
CEO Jason Les directly owns about 2.32% of the company. At current prices, that's worth well over $100 million. So a substantial personal investment aligning his interests with shareholders, at least financially.
Have insiders been buying or selling?
Over the last 12 months covered by the report, insiders were actually net buyers. They bought about 1.48 million shares, and sold around 342,000 compolers. Many of those sales likely related to taxes on stock awards, so net purchase of over 1.1 million shares.
That's generally seen as a strong vote of confidence, right?
Yes, usually interpreted that way, people inside the company putting more of their own money in.
And ownership concentration.
With the top 10 institutions holding a pretty big chunk, ownership is fairly concentrated. This can bring stability, maybe, but also adds volatility risk if one of those large funds decides to sell down their position.
Okay, makes sense. Now for the crucial part, Chapter 6. Risk assessment. Let's use the SWOT framework. What are Riot's core strengths?
All right, strengths. Massive operational scale and the economies that come with it.
Yeah.
Strategic vertical integration via ESS Metron. That fortress balance sheet, low debt, high liquidity. And their durable, low-cost power strategy in Texas, including those valuable power credits.
And the flip side, the weaknesses.
The big one. Extreme dependency on the price of Bitcoin. It's almost a single point of failure for profitability. Then there's the chronic negative free cash flow, meaning reliance on external financing, the history of unprofitability and negative ROIC. And, we have to mention it again, significant corporate governance concerns around that CEO compensation package.
Where are the biggest opportunities?
The AI-HPC pivot is arguably the single largest opportunity, leveraging their massive power and infrastructure for a potentially larger, more stable revenue stream as AI demand explodes. That's huge. Also, industry consolidation post-halving gives them chances to acquire distressed assets cheaply. And, of course, continued mainstream Bitcoin adoption directly benefits their large treasury holdings.
Finally, the threats. Beyond a Bitcoin price collapse, what else?
An exponentially rising global hash rate is a constant threat. It increases mining difficulty, making it harder and more expensive to earn Bitcoin. Adverse regulatory changes are always a risk, and potentially rising energy costs, even in Texas.
What about broader macroeconomic factors?
Sure, higher interest rates are generally negative. They increase financing costs for Riot, and also increase the discount rate used in valuation models, which mechanically lowers the calculated intrinsic value. Inflation can also increase their operational costs, like labor and materials.
And geopolitical factors. You mentioned tariffs earlier.
Yes, that's a major specific threat right now. The potential U.S. imposed tariffs of 2025 on imported ASICs and components from China or Southeast Asia. We're talking potential tariffs of 24% to 36%.
That would significantly increase their costs for new miners.
Absolutely. It would hit capital expenditures hard. However, there's a paradoxical potential long-term opportunity hidden in that threat.
How so?
Those tariffs would likely hurt smaller, less capitalized competitors much more severely, possibly accelerating industry consolidation in Riot's favor. It might also incentivize domestic ASIC manufacturing, where Riot's scale could be an advantage.
Okay, let's bring it all home. Chapter 7, conclusion. Synthesizing all this, what's the bull case for Riot?
If you're bullish, you're focusing on their premier strategic positioning at the crossroads of digital assets and AI. You like their remarkable financial fortress, strong balance sheet, cash, Bitcoin. You value their operational advantages. Vertical integration, that clever low-cost power strategy.
And the growth potential.
Exactly. You see dual growth vectors, leveraged exposure to Bitcoin's potential upside, plus a transformative pivot into high-demand AI HPC infrastructure. You're also encouraged by the significant institutional backing, especially the activist presence, and the strong insider confidence shown by net buying.
Okay, now paint the bear case.
The bear case zeroes in on the extreme volatility and near total dependency on Bitcoin's unpredictable price. It highlights a business model that's currently not self-sustaining chronic unprofitability, perpetual cash burn, reliance on external funding.
Valuation concerns.
Yes. Bears see the valuation as speculative, based on hope and future projections rather than solid current fundamentals. They point to the immense execution risks in pulling off the AI pivot and the exposure to major external threats. Bitcoin collapse, regulation, tariffs. And that governance red flag, the CEO pay, looms large for bears.
And our valuation summary.
Again, that educational DCF model isn't a price target, but it powerfully underscores the extreme sensitivity of Riot's value to future Bitcoin prices and the incredibly high discount rate needed to compensate for its immense risk profile.
So the final outlook, what's the takeaway for our listener?
As of July 15, 2025, Riot's share price around $12.51 reflects a deeply polarized market. To justify buying here, you absolutely must believe in a strongly bullish long-term outlook for Bitcoin, and you need very high confidence in management's ability to successfully execute that massive, complex AI infrastructure pivot.
So definitely not a standard value play.
Absolutely not. Riot Platforms is not a traditional conservative value investment. It's a high-risk, high-reward venture on the future of digital infrastructure. It offers a unique, leveraged play on this convergence of money, energy, and artificial intelligence. It is truly, truly not for the faint of heart.
It leaves us with a provocative thought. In a world increasingly powered by both digital assets and the seemingly insatiable demands of AI, how much value should we assign to the foundational infrastructure enabling both, even when its current profitability is so tightly lashed to volatility? Something to think about. And hey, if you enjoyed this deep dive, if you found it useful, please make sure to like and subscribe to the stockanalytics.ai YouTube channel. It really helps us out.
And remember, for just $4.99 a month, members get priority deep dives on tickers they request. Plus, over the next few months, we're tackling all of the S&P 500 stocks members get exclusive priority access to those deep dives.
Or if you just want a one-off deep dive on a specific company you're interested in, just drop us a super thanks on the video.
And as always, a final important note. This analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be taken as financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.